Okay, so we're going to now continue with closing entries. Chapter 4 talks about closing entries and what happens at the end of the accounting cycle. So very briefly, you've gone through in the previous few chapters, you've gone through the recording process, you've done a lot of adjusting entries, and you've now done a post-adjusting trial balance. So at this point, we're trying to close the accounting cycle using closing entries. So what happens is at the end of the fiscal period, you would close certain accounts into some other accounts. Why we do that and how we do that, that is the focus of today's chapter. So a lot of people get confused or ask questions about why do we need a worksheet. A worksheet is not a financial statement. It is simply a statement, a sheet for you to work through to understand what's happening. Basically, it'll give you the trial balances before you did anything, then you do adjusting entries, and then the post-adjusting trial balance, and then you can use that worksheet to close certain accounts and prepare the financial statements. So, closing entries are done after you've prepared the financial statements. So the three financial statements were, at this point, that we were concerned about are balance sheet, income statement, and owner's equity. After you have prepared those statements, you will close certain accounts. Why do you close certain accounts? Well, because certain accounts are what we call temporary accounts. So, some of the temporary accounts are the revenue accounts, the expense accounts, and the drawings accounts. These are considered temporary. Why we call them temporary? Because they are income statement accounts. And why are they income statement temporary? Because what happens is the income statement gives you information from the beginning of the period to the end of that fiscal period. At the end of that fiscal period, these accounts have to go to zero, so you can start the new period. So that's why we close these accounts into the balance sheet accounts, because balance sheet accounts are just there to give you a picture of what has happened for that company at that point of time. What are the balances and so on. So we close these accounts into the permanent accounts, which are again called the balance sheet accounts. How do we do this? Well, there are a few steps. So first of all, what you're trying to do is you're trying to close the revenue account. The normal balance of a revenue account is a credit balance. So how would you close it? You would debit that account. What happens is, in order for you to make it zero, you would do the opposite of that normal account balance in order for you to close it. If you do a debit to revenues, you must do a credit to something else, because accounting is a double entry system and you need to balance, and all debits must equal all credits. So when you debit the revenue accounts, you can simply credit the capital account. And you can see that revenue account would be zero and the capital account would go up. I know some of you guys may have used the income summary account. It is not a necessity. Income summary account at the end becomes zero anyways. So I prefer not to use it. It is simply a process of just elongating the closing entries process. So I would just close it directly into owner's capital account. The second step is to close the owner's drawings accounts, expense accounts in this case. You close the expense accounts. The expense accounts are, normal balance is debit. So you would credit the expense accounts, all of them individually or combined, and all of those expense accounts will then have a zero balance. And you would debit the owner's capital. And remember, if you are debiting the owner's capital account, it is decreasing. So expenses decrease the owner's capital account at the end of the year. The last step is to debit the owner's capital and credit the owner's drawings account. Owner's drawings account is really a type of an expense, which we'll talk more about in the future. So it is really a type of an expense which becomes part of the income statement as we progress through this course. So these are the main steps for closing these accounts. Debits and credits are equal, and you debit and credit the opposite of the normal balance of these accounts. So after you've done this, perhaps you want to check if everything is closed properly, are all your temporary accounts zero, and if there is any issue with the owner's capital account. Once you have closed these accounts, you would then prepare the post-closing trial balance, most likely on that worksheet with the long, 8-column worksheet. By the way, a lot of these worksheets are no longer in use. They are just a learning tool. Most accounting systems have built-in things within them, so what you do is you have to know what journal entries you're using, and then everything is populated by the system. So the last step, as I said, was to create a post-closing trial balance, and voila, you have now completed the accounting cycle, which was the 9-step process. Once you've created the accounting, completed the accounting process or accounting cycle, you would then move on to next fiscal year, and that would really help you along. The closing entries will help you along moving on to the next fiscal year. So now moving on to a few different things. Well, I just wanted to touch base on what are assets, what are liabilities, define them a bit more. I know I've defined them in the early part of the course, but just to give you a bit more on what they are. Assets are usually broken up into two components, current and long-term. Current assets are those assets that can be converted into cash within a year, or that are cash within a year. So these assets, examples of these assets are cash, accounts receivables, prepaids, supplies, inventory. All of these are current assets. They were supposed to be or required by GAAP to be listed in the order of liquidity. No longer the case under IFRS. Under ASPE, it's still a requirement, or not a requirement, but a suggestion, but under IFRS it is no longer a requirement. Then you have the long-term assets. Long-term assets can be named by the name that they have, the building, the cars, and so on. Usually what happens is when you open up a balance sheet, you will see one major asset called property, plant, and equipment. Property, plant, and equipment usually means land, buildings, and manufacturing equipment, and cars, and anything they have. They put everything, lump it together into one asset line called property, plant, and equipment. And then in the notes section, which is after all the financial statements, you will break down what is actually in the property, plant, and equipment. Usually, as I said, on the balance sheet, on the face of the balance sheet, you will only have one of this as the major asset. And then you have some other assets, such as natural resources or long-term investments. Long-term investments are those investments that you have initially bought, let's say stocks or mutual funds or other things, but you don't intend to sell them within a year. It's all up to your intention. It can be short-term, it can be listed as short-term or listed as long-term, depending on what you as the business owner or the business executive are looking for. Same thing for liabilities. You have current liabilities and you have long-term liabilities. Current liabilities are those liabilities that are expected to be paid within a year, and long-term liabilities are those liabilities that you would probably pay after 1 year. Sometimes you have liabilities which are broken down. Same liability, some part of it would be in the current liability and the other part of it would be in the long-term liability. For example, a mortgage on a building. So some of it you're paying during the year and most of it you're paying after the year. So that's how you would break it down. And then you have equity. Equity is basically assets minus liabilities. This is what you own. In the sole proprietorship businesses, they're called they're called owner's capital. In corporations, they are called shareholders' equities. And we'll come to those, as I said, after this unit. Very briefly, I want to introduce you to measures of liquidity. Liquidity, in essence, means how much cash you have. Can you pay your accounts payable on time? Can you pay your loans on time? Do you have enough cash to to pay all your obligations. So there are two ways to test the liquidity of a company. One of it is called the working capital, which gives you the dollar amount. So current assets minus current liabilities. It gives you, the answer is a dollar amount. Do you have a positive cash flow or do you have a negative cash flow? Can you pay your immediate loans with your money that is immediately coming in, or can you not? Current ratio would be current assets divided by current liabilities. So this gives you a ratio of the same amounts. So I'll stop it here, and then at this point, basically we've covered chapters 1, 2, 3, and 4, and we've completed the accounting cycle, which in essence is the bookkeeping cycle, and you should be very well versed on how to do all of these transactions. And if you're not, please watch these videos at your leisure time.